Alright, well, time to go over another one. Oh, shoot, let's not do that. Time to go over another valuation. Arista Networks this time. If anyone knows about Arista Networks, they're the main competitor to Cisco. And they also, if you look at their balance sheets, income statements, cash flows, you'd see absolutely astonishing growth. Let's just get a sneak preview. Um, I mean, I could zoom out here and you would still see the same trend. It looks like a wave just going up. Seeing EBITDA go up year after quarter, quarter after quarter like this, I mean, Jesus, like everything is just insane. Anyways, let's get into it. So again, my method is using some valuation models, using some qualitative aspects, and then mainly uh, giving the qualitative aspects the benefit of the doubt if the case is that the intrinsic value is at or below the price of the stock, if I think it's qualitatively enough. However, in this case, we still have an upside with the valuation. Um, so let's get into that. For the multiples model, again, I've been over this one time, but we just took the EPS estimate for 2026, the general analyst consensus. I took the price to industry for the concentrated, or the price to earnings for the concentrated industry, its main competitors. I mean, really, its only competitor is Cisco, but I took some of these as well. Took the average and mean, took its forward price to earnings, and then I took its historic price to earnings, which is actually uh, or its historic forward to price earnings, which is actually completely similar to its current price to earnings for forward. And then I averaged all of those out. And then I actually lifted this one, or kept it basically the same by general business thoughts. And my reasoning for this is that ANET, or I'm just going to call it Arista. My main reason is that Arista is consistently growing, as I showed you before, in all of those financial metrics and they've always traded at a lofty valuation, which has always been supported by the growth. If you look back, they've always outperformed the S&P over the past 5 years, up 572%, while the S&P is up about 95. So that shows me that even with its justified, historically, it's also trading at the same amount. Even with that, it's been able to outperform consistently. That's why I think that this is an appropriate price to earnings. And if we're just basing that off of the earnings per share of 2026, well, we're just going to get a valuation of about 105, which in this case I labeled as a sell since it's less than 15%. I should probably change it to avoid. Yeah, we'll do it right now. Probably change it to avoid or something else like that. I'm not quite in a sell. But for this model, it shows limited growth to the upside, at least with this one, 13%. However, that's why we take into account multiple models. So again, when we look at tech companies and we use a gram number, it's really going to look terrible. I like having it up here, but again, it's going to look terrible because of the method of Graham's valuation and how it's tied to book value. And since it's a tech company with a lot of intangible assets, since a lot of it is data driven, they're going to have a terrible Graham number, which you see here is about 23, which is a total avoid, 75% downside. However, it is a tech company that is a strong growth company. So using Graham's growth model, we take this into account. We're using the trailing 12-month earnings per share again. Price to earnings of a company with no growth, we're using 8. I mean, really, we could even use 10 to 15, which would signal it even higher. Uh, but for this sake, let's stay conservative and say 8. That's very conservative. Um, yeah. And then if we go to a long-term growth rate of about 20, I found this by going back here. You know what? Maybe it's just easier if I actually do this. Let's see here. Let's see. We can go here. Take this out to tab 2. Yeah, let's take this out to desktop 2. And can bring up Qualtrim for you. It's a very nice site. I love using this. Shout out Joseph Carlson. Yeah, again, this is where I got these charts from, by the way. But I found this just by looking at revenue growth, net income growth. Over the past 5 years, revenue has been about 30% a year. Earnings per share has been about 42%. I think there's other statistics as well. I'm sure this free cash flow has also been about 26%. Free cash flow per share has been about 25%. Um, and so I just took that and also looking at Seeking Alpha and some other sites. I came to the general consensus that it's going to grow at 20% over the long term, especially since it's early in its stage in taking market share from Cisco, which I'll talk about later in the qualitative aspect. Um, Other than that, using a growth multiplier of 2, I believe is justified since again, it is a early stage company. It's unlike Google that has been present and dominant, even though they're still growing for a long time. I think a multiplier of 2 is justified for Arista, especially using this Graham model, which is not actually it is actually the Graham model, not this one I have right here. That's slashed to 1.5. Um, After that, I took the average yield again of a AAA corp bond and the 20-year average of a AAA corp bond. And then we plug that into the formula, and we get an upside of about 37%, which is a buy here. And then if we move to a price to book industry multiples model, again, just price to book, took the industry average. Its average return on equity is 30%. I looked back and seen that on the balance sheet, their shareholder equity base is high, and it's been about a return on equity of 30% over the past 5 years on average is about 30%. So I think it's justified as we go into that. Additionally, they also retain 100% of their earnings. They don't pay out dividends. Um, so again, that's going to justify the return on equity that they're putting into the company or that you're getting out of the company. Yeah, anyways, I took its book value per share. I took its 5 year average price to book. I took the industry average price to book from up here. And then I took the S&P's price to book, which I still have it at about 5. The retention ratio, justify return on equity. And then I applied that here of the retention ratio times the justified return on equity, which is going to give us a growth of about 30%, is what I believe it should be, which gives us the adjusted book value per share right now of about 10.10. And plug that into the formula of just averaging out the book price per or not the book price per share, the 5 year price to book, and then the adjusted growth in book value per share. Or the price to book, the price to book currently and the 5 year average price to book, multiplying that by the book value per share is going to give us about 20% upside. And then on to the discounted earnings per share model. Using the trailing 12 months earnings per share, 2026 estimate, there's a growth here of about 27, 26.5%. And then 5 years, over the past 5 years, it's historically grown at 27. If you average those two out, you get about 27. And then conservatively, you can say it's about 25 if you're going to apply that for the future. And then I believe an appropriate price earnings ratio is about 35. Again, it's traded around this near its whole lifespan. Um, Here, actually, maybe we can actually go see this. Mm-mm. Yeah, it's traded around this region. Actually, even a little bit higher. Got really devalued here. Would have been incredible buying opportunity, which I believe I did. But yeah, it's been trading around this 40 to 42 and a half range, which is really higher than 35. So if you want to take an appropriate length for it, you could totally just say 35, which is what I did here. So I projected that out. We got this with no discount. That's wonderful. We took the terminal price to earnings. Again, we took 8 because that's the price to earnings of a company with no growth. Could even be 10, but we took 8. We took the risk-free rate of about 4.43, which actually recently this has been changed to about 4.5. So we need to take that into account. Then we have a beta of about 1.42. So it trades more volatile than the S&P. S&P returns, and then the market rate premium is going to be S&P returns minus the risk-free rate. And that's going to give us our risk of investing in the stock market. Then we find the discount rate. simply by adding the risk-free rate and then the beta times the market risk premium, how volatile investing in the stock market is going to be with this particular company, and then we add that to the risk-free rate, and that's going to give us our total discount rate. And then we'll have a terminal earnings per share growth value. I almost always use 4%. You could use 3 to 5, but I go right in the middle, 4% for any company. And then the year 5 value, if there was absolutely no growth at its terminal value, would be about 57.62, which obviously is not great looking. Um, However, when you project out these earnings and then discount them to their present value, another thing I like to do again, I think you've seen in my Google one, is I like to kind of taper off the price to earnings as it gets closer and closer to that 10-year mark. And then we trade around the 20 mark. Um, and that kind of flattens it out, which funny how that kind of works out to be the same. Anyways, after about 5 years, we get 142% upside of current valuation right now, which gives us a buy. So let's go to the qualitative aspect. Oh, well, right after the valuation here. Again, I put them all right here. Got the current price, got its intrinsic value as I averaged out all of these models. Gives us an upside of about 52.5% as of today, which is a rating of a buy in my books on the valuation side. Um, Applying a margin of safety, it's still going to be about 120, 30% upside. Definitely still a buy. If we look at analyst ratings, we have about 21 that rated as a buy, 4 rated as a hold, and no one saying to sell it. So let's go to the qualitative side. First off, I like to do this with everything. Let's project out the cash flow yield as it approaches 10 years. So we can see the risk-free rate today is about 4.5%. It was actually just changed because of the treasury bonds that were auctioned off for the U.S. debt, ended up raising to 4.5, which is kind of concerning. But that's a whole different topic, I suppose. Not really associated to quality companies. More of a U.S. debt bond market issue. But yeah, it raised to 4.5%. And then we have a net yield here. I believe the growth rate I used was 15%. Again, that's conservative from the one I used past, which was 20%. But we used 15%. If we applied 20, I believe, what did I use? I believe I said 20, right? Oh, well, this is cash flows. My bad. This is cash flows. Totally forgot. Anyways, I found these cash flows by going here. I went to free cash flow. Found that over the long term, 25.41 for 10 year, if this is per share, and then free cash flow in general is about the same. Um, so we discounted that severely um, to about 15%, which really, this could be upwards of 20%, which in that case, we'd reach um, a point of tangency at about 3 years in. You'd be getting a higher cash flow rate. Um, I believe 20 is more appropriate, to be honest. Anyways, let's start on the thesis. So, the main competitors to Arista are Cisco, Juniper, and I believe, oh my god, why am I totally blanking on the name? It's not MicroStrategy. Motorola. Yeah, Motorola. The once phone company turned into data provider. I'll show you the statistics down here. So the advantages that Arista has is that its Ethernet switch segment, which has about 20 to 30% market share, which is what they really specialize in. And then the very promising part of ANET Arista is that its growth has been absolutely phenomenal, which is shown by its beat on every earnings report and analyst expectation, and they're easily the fastest growing company in the communications services sector. If we look down here, um, I got this off of Seeking Alpha. I don't have the premium, so you won't see the sector relative grade. But just look at the difference to the sector. Revenue growth year over year is above 270% for the difference of the sector. Revenue growth for the forward year is about 180% expected. EBITDA is 225 for year over year. Its forward looking is 111. Its EBIT growth year over year is 142, and then its forward is 107. Its diluted earnings per share growth year over year is 215, and then forward is 91%, and then its gap growth earnings or gap growth is 439%. Which I mean, all of these are positive, meaning they're all above the sector, which I believe justifies its total growth, and one of the main reasons I'd be investing in this company. Anyways, Cisco is the main dominant force, but growth is past, and I think that they're a mature company, as you can see in their revenue and earnings per share. Usually, it's a bad sign for any tech company if they're mature because they're no longer innovating in the game. They're kind of just sitting there and doing what they do best, which, that's good for an organic growing company like Texas Roadhouse or Chipotle, even. Um, but they're not that. They're a tech company that has a lot of data infrastructure implemented in a lot of places. And if they're not changing that, then a new competitor is going to come in and sweep that market share, which I think Arista is going to do. Um, Anyways, with Cisco, the revenue's flatlined, earnings per share has fallen, and then the dividends has risen, which is a good thing if you're holding this for passive income. But it kind of furthers the narrative that they are mature and they're kind of straying away from retaining those earnings and investing them, which is one of my key investing philosophies, I believe, for growth is companies that are investing in that AI infrastructure. And Cisco is not doing that. They're just raising dividends, which is good, but not my goals. And then as for Motorola, they were once the thriving phone business. They kind of got absolutely crushed as soon as Apple, Android, Google Pixels started becoming a thing in smartphones. Um, yeah, and that after that, they kind of switched to the public safety communication equipment for like police, fire departments. They kind of provide the communications for those, uh, the fast switch responders. Um, and so the switch from that kind of transformed every fundamental drastically, but they did cement themselves as a serious, still growing contender in the industry. And they have consistently increased dividends and kept cash investing consistent, which signals that it is still a prominent business that is predictable and profitable. As you can see here, this is when the thriving phone business, smartphone came out, also the financial crash here, but smartphone came out and they kind of switched to this new narrative of slowly growing revenue over the past time. But as you can see, over the past 10 years, you look 2020 or 2015 to 2014 to 2024, it's grown on average of 6.4% every year, which is good, consistent growth, but it's not like Arista where you'd see the incredible, like, I don't know, what was it, 40% growth over 10 years or 30% over 5 years. Again, with the earnings per share, it kind of tapered out or kind of was flipping up and down, having rough times, and then they kind of stabilized. And then in 2017, 2018, I'm not quite sure what happened here, but they ended up flipping it back, and it's been growing consistently. Um, did I say they were investing up here? They kept cash and investing consistent. Yeah, one of the main things I like to see qualitatively is a company, a tech company mainly, that is heavily investing into AI infrastructure from their cash flows. And, they're investing cash still, which is a good sign. Also, this dividend growth is remarkable. It's really great growth. And they are still investing consistently, but I believe that Arista is going to have them beaten if they invest more. So moving on, Arista is doing basically the opposite of them, which furthers the growth, not the opposite of Motorola, of Cisco. They're doing the opposite, which furthers the growth narrative they have. And historically, they've always beaten in earnings and revenue. They have incredible growth in every fundamental aspect, and they're heavily investing into AI infrastructure. All of these are things that I look out for, which no other routing slash communication company is doing. And then I already showed you the sector difference. It's insane, but yeah. And then also the trailing 12-month status. You can see its earnings per share annualized over the past 5 years is 27 and a half. 3 years is 50%. 1 year is 31%. So again, there's that. Again, you can see its fundamentals here. I showed you this earlier. And then Arista also crushes the competition in terms of margins, and this is very important. Cisco has around 18%. This is gross profit margins. And then MSI, Motorola, has about 19%. Arista has about 40, with the margin growth being stable or growing nearly every year. I'm not sure. I think it's on my other computer. I wish I could show you. I don't have it up. Um, but margin growth has been either consistent over the past 5 years, or growing. So it's either I believe the difference every year is a less than or equal to about 5%, which is what you want to see. But still, 40% margins, gross, I believe. I believe it's either gross or profit. Might be profit. Profit margin is 40%. Operating is actually higher, 42%, um, which is a great sign. But yeah, profit margin is 40% about with it being consistent growth and stability. And then the possible challenges that they face, I have to put this on every single one. One, Cisco is too dominant. Two, the revenue is too heavily reliant on the need for infrastructure. And then three, the EV to EBITDA is much higher than the industry average. And then for my rebuttals for this, I'm going to just read them out. For one, as I demonstrated up there with all the charts for Cisco, they're old, outdated, and a mature business. And my philosophy, again, revolves around growth stories, particularly ones with metrics to back it up. And while Arista is a hefty valuation, I think that their growth potential keeps them compelling over Cisco. And I think that I don't think, they are taking market share from them as we speak. For two, in this age, I believe that AI infrastructure and infrastructure in general is necessary. And then until that time passes, I believe that Arista will play a crucial role in supplying it. And then when that time passes, Arista will need to be reevaluated, as that is definitely a key part of their revenue. And it's something that they hinge on, definitely. So that is a concern for later. However, for now, in this day and age of AI infrastructure, Google wants to build infrastructure, Amazon wants to build infrastructure, and Microsoft. They all want infrastructure, and Arista is basically the supplier of that, which is why I think they're crucial in this part. And then as for three, the EBITDA, um, the enterprise value to EBITDA, this is definitely a real concern, as excellent growth might already be priced into the stock using this ratio. But historically speaking, enterprise value to EBITDA has always been consistent over the past 5 years, 3 to 5 years, of about 5% in this range. And I think this range is about 30 something. What is EV? Yeah, about 35. So it's always been from about 32 to 40. I think it's down over the past little while, I think over a year. But yeah, it's always been in that range, which is higher than the average industry, which is about 19 to 20. Um, and that could be definitely a concern, but I think it's okay, as this signals that it's always been expected to perform in the past 5 years, and then it's always outperformed the S&P. Again, showing this chart back here with the 5-year performance. Um, it had this crash, but I think this is where my valuation is currently, which is funny, about 150, about 140, yeah. So, hey, that looks pretty good if I actually got that. I didn't even know that, so that's cool. Awesome. So I'm going to get back to the final part here. You can think of Arista as the plumbing of the digital world. Every single cloud provider and every single developer needs server infrastructure. That's a fact. And that's something that they sell along with Cisco. And essentially, I believe it's a duopoly, besides Motorola, which is also a player. However, they are more on the government and municipal side, not corporation side, which is really, that's where the money is, let's be honest. Um, Anyways, I believe that they're essentially a duopoly that supplies the biggest tech companies with data infrastructure needs. And additionally, this is just kind of off to the side, but it's fun to know. The CEO spent about 15 years at Cisco as a senior vice president, which adds to her experience, knowledge, network, and then also competitive insight into what they do. Even though obviously it's probably changed over the past 15 years, but it definitely gives them a competitive insight as to what they might be thinking. Overall, I believe that Arista is a buy for these reasons, or for these reasons. So, one, they are the only innovative, growing communications company that is incorporating AI. Two, they have an incredible track record of growth and profitability that has been sustainable. Three, they're heavily investing, which I always think is good in this time. Four, they have sheer growth, which is simply undervalued. Well, four is my last point, but they have sheer growth that is simply undervalued and has historically almost always been and is almost always outperformed. I see the upside here, and it makes me believe that it can honestly be even higher with the multiples I use being conservative. And then when a company rises in price, has a steep fall like we see back here, but they've always been able to keep every facet of their business growing, as you can see on this side here. When was this? Beginning 2025 to about when? March, April, maybe February. Um, Yeah, if they have a rise, a historic meteoric rise, and then a crash down here, but they're able to keep every single metric consistently growing, it is only a matter of time before the fundamentals catch up to the true intrinsic value of the company, which it hasn't yet. That's why I believe it's a buy now. Um, and that is my conclusion for why I believe Arista is a buy. Let me know what you think in the comments if you care. Um, Maybe soon I'll be coming out with just a short presentation of my investing philosophy, as I haven't really gone over it in entirety. And also, I probably got to clean up some of this bullshit here. I mean, this is just really ugly. But that's work for another time. So, see you guys later. Let's see.